welcome everyone to our 2023 webinar. This month, we will help you to understand the tax saving strategy. The first series classes will be RRSP, Retirement Saving Plan. So what is Retirement Saving Plan? So we will touch base on the three major topics. Number one, what is RRSP? It is a registered retirement saving account. And then why we use RRSP to build retirement income. Number three, what are the investment choices for RRSP? For example, I open RRSP, but what kind of portfolio I can create for myself, right? And of course, at the end, we open the floor, open mic for everyone to be able to ask questions. So it will be the workshop after. So what is registered retirement saving plan? I take all the information down from Canada Revenue Agency. So this is the website, www.canada.ca. Okay, I summarize the information in the government website. Registered retirement saving plan. It is an investment account. So when you put the money there, you can save up for your retirement. Usually in Canada, retirement age is at the age 65. So when we look at this investment account, and there's three stages. Number one thing, how to set up an RRSP account. You can do this in the different financial institutions. Or the second one, contributing to RRSP. So it's very important to look at your notice of assessment from the Canada Revenue Agency and to find out your RRSP room for this year or accumulated room that you haven't been used, okay? Of course, it's very important to also understand when I withdraw money from RRSP, is it taxable or non-taxable? It really depends. So in two situations, when you withdraw money from RRSP, it's non-taxable. Situation one, home buyer's plan. You can withdraw up to $35,000, put it as a down payment for your house, then it's a tax-free. Of course, because this plan was set up, the purpose is for your retirement, right? So you do need to repay this money within 15 years. Another scenario, you don't need to pay income tax on the withdrawal of RRSP. Up to $10,000 is lifelong learning plan. What does that mean? I want to go back to school and I need to have some money to pay for my tuitions. So you can withdraw up to $10,000 tax-free. However, we never want to defeat the purpose of saving for retirement. So the repayment period will be the next 10 years. Other than those two reasons, if you say, well, I need to use the money have an emergency purpose, right? And then you withdraw the money, depends how much you take it out. Up to 5,000 will be 15%. Between 5,000 to 15,000 will be more, 30%. And above 15,000 will be 45%. So it's quite heavily. So that's why our suggestion is that to invest this money for long run. When you retire at the age of 65, you withdraw the money, your tax bracket will go lower, and then you will be able to defer your income tax. One thing I really need to bring to your attention is that type of account is not equal to investment products. What does that mean? A lot of people open an account and say, oh, I have RRSP, but when they only put the cash into this RRSP, it doesn't really help you to use the money to make money, okay? So before we would explain more about that, I would just like to help you to see all kind different accounts, okay? There's a different accounts when you open the account in the bank, for example, checking account. This is for your cash inflow, cash outflow, okay? Daily expenses. And saving account, mainly we put it there, 3 months, 6 months emergency fund, okay? When you have both saving account and checking account, then you say, I have extra money. I want to use money to earn money. And this is a saving and investment account. So we have different choices. So whenever you see the letter with R, it means what? Register. Register with whom? Register with Canada Revenue Agency. So we have a registered account, we have a tax-free saving account, and also we have a non-registered account. So briefly to share with you, what does that mean? So the letter D means what? Disability. Whoever got disabled, you can put in 1,500 per month, per year. Then the government will give you 3 times of the money. In the long run, 20 years, the government will help these vulnerable people with 90,000 maximum subsidiaries. RRSP, or the family with young kids, will be able to say, well, you will have a 30% from the government in Quebec, and also you will have the capital gain when you invest for the long run. And then when the kids go to school, you will have a good lump sum of money to pay for their education. RRSP, this is what we focus on, is for your retirement. It really depends how far you are from your retirement ages, right? So usually we will say it's a midterm and long-term investment. Tax-free saving account, starting January the 1st, we say, well, we have a new room for 2023. So a lot of people call us to open the tax-free saving account or recontribute to the same account. So this is a very flexible account. You can put it like a short-term, medium-term, and long-term saving. Whenever we withdraw the money, it's tax-free. So it's a very important tax saving tools as well. Then when you maximize, use all the other accounts, benefit from all the other accounts, you still have extra money. You say, well, I would like to have a non-registered account. It is like a pure investment account. You can have this account like a joint account, husband and wife. Also, you can put in more like a different denominations. You can say, well, I can save money and invest money in a Canadian dollar or in US dollars. Okay, so this is like the type of the accounts and what's the purpose for each account, right? When you get this right, now let's look at the next. What are the investment choices you can put into those accounts? So when you open an account, of course, you move the money from your bank account to those specific accounts, right? For example, today we talk about RRSP for retirement. Then people can hold some GICs or bonds, government bonds and corporation bonds. For us, how we can help you? We help people to put the money in safer places. We say, well, it's very important to diversify so you can reduce the risk, right? So we don't put all the eggs into one basket. So what we can help you is in the blue section. I have a both license, so I can help you to put money into the mutual fund if you choose to invest in the mutual fund. And now we would say segregate fund is also a very good choices because on top of the mutual fund, you will be able to have the principal guarantee at a maturity date and upon death. Of course, there's 2 insurance products. A lot of people may not know a lot about that. It's a whole life and universal life. You can build the cash value within this policy, so that can be as a retirement income. The other one, critical illness, we say, well, with the return of premium option at the age of 65, and then you will be able to also pull out the money as your retirement, supplement income, right? And the other one, like stocks, foreign exchange, options, future, hedge funds, and derivatives, such as swaps, those are more like for the sophisticated investors. So the people know what they are doing. Those are not the scope of our work, but we don't give advice on those. If a lot of people like are really keen into the investment, and they will do this for themselves, okay? And why RRSP? So we say, wow, what's the benefit there, right? And we also would like to know how to optimize RRSP each year. So here I'm going to show you the strategy. Why we need to use RRSP. So let's look at the retirement out there, okay? A lot of people, we do need to ask ourselves one big questions. Do I save enough money for my retirement, right? So we look at the statistics out there. 39% of Canadians has no saving for retirement. So they are quite vulnerable. They need to start to do so, right? 53% of Canadians live paycheck to paycheck. What if they lose a job? It's very risky, shaking. right? 69% say they wouldn't have enough saving to last through retirement. Yet, what if you outlive your money? That's another issue we need to help people to deal with, right? So I'm going to address to all those issues later. Look at the government pension. Yeah, we say, well, can I rely on the government for my retirement? So we say, well, the government will give every Canadians a certain like a pension. However, it's not sufficient. Just look at the number. Old age security. If you have been in Canada more than 40 years after age 18, you will be able to have the maximum amount, 626. And then Canada Pension Plan in Quebec Pension Plan, QPP. So maximum is $12,100. When you add those two numbers up, you have the total $18,100, but you still need to pay 20% tax. So after tax, you only can take home $1,400,000. So we will say, consider the inflation. Every like food prices is rising is really not sufficient, right? So we say, well, the Canadian pension, the government pension is not enough. Now, what can I do? If you work in a very big corporation, a good company, they offer you the company pension, that would be great. And however, a lot of people say, well, I just jumped from one job to the other job. You might not have a very good pension build up with your employer, right? Then now we come into the picture to help you to set up your own personal savings. You can put your money into RRSP, tax-free saving account. We also have a wealth account, what we call the insurance products that you have the investment in, mechanism inside those products. For example, whole life, universal life, and critical illness. So next, we would like to help every family to build 8 ways of retirement income. Okay, so only when you have a multiple source of income for your retirement will be secure, right? Number 1, old age security. And Quebec pension plan or Canada pension plan, we say, well, government pension is not sufficient. A lot of people not necessarily have the group pension plan, RSP, then we need to help each family to build number 4, 5, 6, 7, and 8. So today we focus more on the personal RSP. And then, of course, in the 3rd week, we will show you how to set up tax-free saving account. And when you have extra money, put into the investment account, non-registered. 7 and 8 are the insurance products you can use as a saving tools. For example, critical illness, save for your retirement. If it has no claim before age 65, you can have the flexible return of premium and use it as a supplement income. Then permanent insurance, life insurance, and we will do this in the other topics, okay? So how to understand your payroll, where your money goes. A lot of people say, well, I work very hard, but I just feel like after paying all the obligations, not much money really deposits into your bank account, right? So just look at the payroll in Quebec. So let's say this person earns $60,000 per year gross income, and we need to pay all the obligations. You have employers portion, and you have employees portion, right? So we pay unemployment insurance, contribute to Quebec pension plan, contribute to QPIP, the parental plan, then pay federal income tax, Quebec income tax. When you deduct all those monies, you feel, well, that's not much I can bring home, right? So here, I would like to show you the scenarios. If you don't do any RSP planning, so how much money you need to pay to the government for the income tax? From the federal, $5,644. For the Quebec, $7,000. So altogether, $12,600 is quite a big amount, right? So you say, well, how am I able to get the money back? I want to save more income tax, right? So for example, if you accumulate the room, $10,800. So this year, you can open an account, RSP, put this amount of money for your own retirement saving. And then by doing this, you are able to save $4,000 income tax. So this pretty much will help this family to create net income for about 1 month, right? So here, let me just do a summary. How can RSP benefit you? Number one thing, we know that you can save income tax for the current year, okay? You get tax refund, $4,000, that will be like the tax save is the money you earn, correct? And of course, you will say, well, whenever you have this like a extra tax saving, let's say you got a tax refund, you can also reinvest either into the RSP for the next year saving strategy, or you can put into the RRSP or put into the tax-free saving account. Of course, we can also show you different other investment instruments that can help you to be able to have a long-term retirement income, right? Good. So next, I would like to show you the investment side. What are the investment choices for RSP account? So that's why we say, well, we have so many investment choices where I should put my money and how I should choose the investment, how to create a portfolio, okay? And before we do that, I would like to show you a big picture, especially for a lot of people who never do any investment. They will always hear the terms like there's always a risk, right? So I would like to show you the big picture. For example, this person, 1934, invests $1,000. So how this $1,000 can become after 86 years, when we come to see the long term 2020, in the year 2020, pretty much it's 86 years, let's say a people's lifespan, right? So this is a one-time lump sum money, more like a seed money planted here very early. And then the money will grow. So when you put into the different market, the money will grow in different ways, right? And we have like a very growth aggressive portfolio. We have a balanced portfolio. We have a conservative portfolio. And the minimum, the bottom line is that no matter where you put the money, you just look at the curve. Every curve is ups and downs, right? However, in the long run, you always see the trend in the long run is always going up. For example, if you invest the money into the US stock market, $1,000 can become 9.9 million. Okay, this is a compound interest. So that is the 8th wonder in the world. That was like figured out by Albert Einstein, the greatest physicist in the world. So we say the bottom line is that you need to beat the inflation. If you never invest any money, this $1,000 are losing the purchasing power, right? Because after 86 years, you need to have 18,000 to be able to purchase the good that was 86 years ago, okay? So that's the value of money. And when you look at the big picture, now let me help you to understand the different category of the portfolios you can choose. 3% conservative, 6% pretty much average balance, and 12% the average rate of income for rate of return for aggressive or growth portfolio. So we say Albert Einstein say this is the wonder of the 8th wonder in the world is the rule of 72. So he used a mathematics formula to explain how your money can grow, can double. So the formula says 72 years divided by number 72 divided by average rate of return per year equal to how many years your money can double. Okay, so you will see the difference. 3%, your money double twice when you retire. So 2,000 will become 8,000. 6% will double every 12 years. So retirement age comes 32,000. If you say, well, this 2,000, I will never touch this money. I just put it like a C there. For example, the paragraph I show you, they just put it there, they forget about that. Until at the age of 68 and look at the balance, it will be over 500,000, okay? So this is more like the magic of compound interest rate, right? So a lot of people say, well, I don't have the lump sum money. Can I do it more like a monthly contribution? Yes. So in another way, we say, well, if you would like to put monthly contribution, 200 per month, 300 per month, or 500 per month. Let's just do an average 7% rate of return, net return to the client. So we would like to show you how your money can grow after 10 years, after 20 years, after 30 years, right? The longer your money is sitting there, you will be able to building up a bigger portfolio, okay? So let's say 200 per month, I keep on doing this for 30 years, you will have a close to $250,000 portfolio. 300 per month, you will have a more than 300,000. Of course, if you can say, well, I can save 500 per month, and then after retirement, 30 years later, you will have over $500,000. So that's why you can do the planning right now, how much you need at the age of retirement, and then we can do the reverse engineer to figure out how much you should put in every month, right? So a lot of people question me, say, well, is this real? Is this workable? So let me show you the paragraph, how we are going to grow your money, right? So this is how we run the illustrations for people, projection for the next 30 years. I put in 500 per month contribution, average rate of return 7%. And then we need to show you the wealth formula. It's not just about the money sitting in your bank, the numbers in your account, right? Your money there is more like a seed money. We need to help you to find the good places, like a fertile ground to plant the seed. So this seed will grow to be like a harvest, right? And the most important factor here is time, because you see, 10 years, your portfolio will be here, 20 years will be here, but after like 30 years, it will become a much bigger amount. So we help you to find a good portfolio to be able to suit your investor profiles. Then also we need to help you to fight and the big inflation. Now it's 8.1%, is a quite challenge. And also the tax consequences. Whenever you withdraw money, we don't want you to, how to say, pick up too much like a tax, right? So only then we can help you to create your wealth. So there's a lot of factors we need to consider. So that's why you say this paragraph, we run the, how to say, software, we say, yes, 588,000, it is achievable, correct? However, I always would like to inform everyone, life is not like this. It's not the smooth ride, right? The investment, the stock market, the financial market is also something like that, okay? Sometimes up, sometimes down, but we will see, well, eventually your money still grow in the long run, okay? So a lot of times we say, well, do not just look at like a short term, medium term, and when you look at the long run, and your money will be able to really create wealth for you, okay? So this is what I would like to how to say, bring up your attention, okay? Next, let me see. So now let's like expand the timeline. You say, well, am I saving sufficient for myself, right? Earlier, I raised that question. So at the age of 65, you retire. Let's say you can live on for another 25 years till age 90. And how much you build up and how much money you can withdraw from this portfolio. Okay, so I give you this like different scenarios. For example, you already built up 200,000 into your RRSP, and for the next 25 years, you can withdraw 15,000 every year as an income supplement for your retirement. Of course, everyone have a different lifestyle, right? If you say, well, I would like to have a better lifestyle, I need to have like a 60,000 per year, then you do need to start to save your money now, okay? You can put it into the RSP, tax-free saving account, or non-registered account, or different like life insurance products. You build a cash reserve over $800, and then you will be able to see what every year you can be able to withdraw 60,000. So this is a much better lifestyle, right? And then I would like to also show you the places we suggest to put into the money. especially nobody can control the financial market, right? It's going up, it's going down, it's just like a wave. And we all know that there could be a bull market like this. There may be sometimes like a bear market. So we would like to help people to guarantee your principal at the maturity and upon death. So we say, well, segregated fund could be a good place to put your money, because retirement, you cannot afford to lose money, right? Look at this diagram. This example, John is at age 40. He planned to retire at the age of 65. So his timeline is 25 years. Let's say the first 10 years is a bull market. He put into his plan investment 100,000. Then the money keep on growing. And at the age of 50, it's already grown to 140,000. So in the segregated fund, we have a reset function to help client John to be able to guarantee his principal up to 140,000. Now, let's say, well, too bad, very unlucky. The next few years is a bear market. At the age of retirement, age 65, the market drops, and his 100,000 investment becomes 75,000 at market value. So he suffered loss, and nobody wants to see that, right? But when we help you to put into the segregated fund, you know what? Even though the market price is 75,000, but how much John can get at the maturity day? He can still get 140,000 because we put this money into with the insurance company, and the insurance company will top up the difference. So make sure they will compensate you. So the principal guarantee will be 140,000. So that will help the client to have the security, safety in their heart, right? And now we would like to show you, I mentioned earlier, you can open an account into a different financial institution, right? So those are our business partners in Canada. We have a Bank of Montreal, we have a B2B bank. The fourth week, I'm going to show you how to use the RRSP loan strategy to leverage accounts. And we have all the many financial institutions like a mutual fund, segregated fund company work with us. And then we can select a variety of choices for our clients. We also have a category of like insurance of person. Those are companies offer the protection for health, for life, for travel, for dental, and for many like a group insurance as well. Aon is the largest damage broker in the world, so we offer car insurance and commercial insurance, and as well as your home insurance as well. Okay, so that's pretty much I would like to share with you tonight. My name is Hailing, and we represent a group like a Wells Canada. This is like our team. We always up there to help you and serve you, and feel free to ask us if you have any questions. Okay, so that is what I'm going to share with you.